This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Bill's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build of 3.6 million barrels on crude oil, Cushing, Oklahoma drawing down 226,000 barrels, gasoline building 2.7 million barrels, distillates building 377,000 barrels, for a net petroleum build of 6.7 million barrels, with U.S. production holding unchanged at 13.2 million barrels. The chart's starting to look a little tired here, maybe rolling over just below $82 on the WTI chart. I could see the next $10 in either direction from here, depending on how geopolitical developments play out. So I'm flat and focused on other markets at the moment.
Yeah, Eric, that $82 level on WTI is actually the 61.8 retrace. And so typically when a market is oversold, it will bounce into a retracement zone. So this, at least up until now, can't be disqualified as simply a secondary reaction. And arguably, if a bearish catalyst emerged, it could send oil to double bottom retest its lows. This 82 level, just like you're suggesting, is a pivot. And it's a pivot that the bulls need to beat in order to start establishing a new bull trend. And I know that there's a number of CTAs that have already gotten bull buy signals, but we still haven't beaten that key hurdle. And I think it will be key. To me, any pullback here of the $3 to $5 variety, if the bulls are in control, should be bought on dip. And we should see the price action return to these levels to generally show that accumulation has started. And so that's going to be revealed in the next week or two. We'll keep a close eye on that. Now let's get Nick into the conversation. Nick, what levels are you watching on the S&P 500 here?
Yeah, Patrick. So right now the spot price on SPX is approximately 54.80. We have an implied move for the July 19th monthly OPEX of plus minus 110 points. Therefore, the upper implied move is 55.90 and the lower implied move is 53.70. Right now we have no key resistance given that we're at all-time highs, and key support resides right around 5,400. I'm inclined to think we see a move up into the July monthly OPEX, as that tends to be the strongest period of the year, followed by a pause into the election or so.
Nick, it's interesting because last week we were talking about the idea that the S&P 500 would put in actually its top the day NVIDIA put in its top. And last Thursday was exactly that. On page 5, I have the NVIDIA chart, and you see that bearish engulfing candle and what's been now 4 or 5 days of distribution off the high. It's interesting that MU just had a disappoint on its earnings and is heading down. The question is, have we seen the top there? And is the idea that will mark the top on the S&P going to be the case? What's interesting as well is that the S&P hasn't reacted as much, even though it's put in a short-term high, because stocks like Amazon and other Mag 7s have actually picked up some of the slack. But will it be enough? These are the puzzle pieces to solve here. Overall, this continues to be a market that gets narrower and narrower on market breadth. On page 4, what we see is that from the January high, where we had over 90+% of stocks participating, we got to the March high with 85% of stocks bulling and participating, to the May high, where we had 65% of stocks bulling at the peak. And the recent high, when NVIDIA was up putting in that top, we only hit 60%. So what we're continuing to see is deterioration of the breadth. The market continues to be carried only by a few big names. And I continue to think the way NVIDIA and others play out here is going to be critical. Is the high for NVIDIA definitively in? Absolutely not. The bulls could slam it north of 135 and punch another advance. Don't want to already put nails in the coffin there, but I think it's going to be the centerpiece puzzle puzzle piece to solving whether or not the market does have that rally into July or not. Anyway, what levels are you watching on the Qs?
So right now in Qs, spot price is approximately 480, and we have an implied move for the July 19th monthly OPEX of plus minus 15 points. Therefore, the upper implied move is 495, and the lower implied move is 465. Right now, we have no key resistance as we're at all-time highs, and key support resides at around 460. Again, I'm inclined to think we see a move toward a new high into the middle of July, followed by a lull or so.
Nick, though, moving on, I want to talk about this volatility index. We continue to see daily volatility stays at the bottom end of its range. This 30-day vol also down at the 12 handle. Very complacent levels of volatility at this stage. And what levels are you watching?
Yeah, so with the VIX around 13 right now, we can expect to see top to bottom intraday moves on SPX of about 0.75% or so. What we've seen over the last week or so is very, very narrow ranges. So we're seeing realized moves less than the implied moves, which is interesting overall. But as I said in previous weeks, insurance is still very, very cheap to buy out toward that election timeframe. And I think it would be prudent to do so if you are holding a large portfolio that correlates heavily to the S&P 500.
All right, guys, I want to move on to the dollar index. And what I want to highlight is that we are seeing that US dollar yen breaking out to a fresh high. The intervention clearly wasn't as strong as everyone thought it would be at those previous highs. And we continue to see a euro that remains very weak. But when you look at the currency pairings, we haven't seen big moves in the US CAD. We have not seen big moves in the pound sterling. We have not seen big moves yet in the Aussie dollar. And so this is still just a few currencies that are driving it. The big puzzle piece to solve is that will we see a general rise of the dollar really kick in here? And we're trading a stone throw away from the highs of the last year. And it'll be really interesting to see whether that sets in motion a new US dollar trend.
And moving on to page 8, we have that gold futures chart. What are you guys thinking here?
Well, gold is selling off again. Looks set to test at least 2285, maybe lower. And that number of 2285 is really starting to firm up as the support number. I've said in past weeks that it didn't really jibe between the contract chart and the continuation chart. Well, now it's starting to, because the support number on the contract chart has climbed up to 2282, and that is still climbing every day. So it's just starting to converge with 2285, which is the horizontal support level on the continuation chart. So 2285 is now strengthening as a target for where we might see the bottom of this correction, but I still think 2250 or lower is entirely possible here before it's over. Bottom line, buy the dips.
Eric, I'm basically in the same camp as you. Overall, we are in the corrective phase after a very strong bull advance in the first quarter of the year. The correction can still go deeper, but it is, in my mind, still a major buy on dip. Whether we see 2250 or even 2200, we may end up having a very volatile summer. But when you're looking out on the horizon, any of these pullbacks being bought on dip will lead to a potentially big upside opportunity over the next 6 months. And so let's see how far the correction goes and where the buying opportunity plays out.
Now on page 9, we have that uranium chart. Eric, what are your thoughts here?
Not a whole lot of change from my perspective since last week. The market's trying to find a bottom here, but, well, it's a really thinly traded summer spot market. And what's happening is a lot of the uranium mining shares are falling below their 200-day moving averages. That's, kind of freaking out the technical traders. The momentum guys are losing their patience. And I think what's happening here is we just have a very slow physical spot market, and we're not going to see any upside reaction or impetus in the uranium mining shares until we start to see an upside move in the spot price of uranium. It's perfectly possible that the buyers might just take the summer off. We might see a very quiet spot uranium market. If we don't see the action in the physical market, we're not going to get the action in the speculative uranium mining shares market. In the end, there's no doubt in my mind that we'll be proven right, and and the next big move here is going to be to the upside. But look, this correction, it's a famously volatile market. Uranium has huge retail participation. That means that if we see a broad market shock to the downside across broader equity markets, it will disproportionately clobber uranium mining shares because of that huge retail participation. So this could get really ugly really quickly. It would create even better buying opportunities. Already, I think it's a strong buy right here. The thing is, when that move to the upside starts to happen depends on when we start to see the action in the spot market. So far, nothing happening there.
Yeah, we're going on 4 months of selling here, Eric, and this distribution continues. What's interesting is that the spot physical continues to be actually considerably weaker than spot prices, selling now at a noticeable discount to the net asset value. And that in itself, I think, will close and cause inevitably the spot physical to just mean revert a bit. But the bigger question is when do we see another bigger impulse in uranium? Clearly, this is now a 4+ month correction, and we haven't seen the trading low yet. I do believe that we're very close to the levels where the bottom will establish itself, but there's no technical evidence that a new bull trend has begun or that the ultimate low has yet been seen. And so this is a patience game. I still, like gold, think that there's a really big bull story to be played out. It's just a matter of waiting out this corrective phase. Finally, I just wanted to quickly touch on the 10-year U.S. Treasury yield. We had a little bit of a pop in the yield, but overall, it's going to be really interesting to see how it reacts to the PCE price index, some more inflation data. And we do have the Fed minutes coming up next week in the middle of the holidays and the job numbers. It'll be really interesting to see whether or not yields weaken after that, and maybe potentially economic weakness or tamer inflation emerges. I think overall, we've seen a considerable swing high out in April in yields near 470. The bigger question is that are we going to see yields head back down to 4% or lower in the summer, or is that something a little bit farther out in the fourth quarter of the year?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.